Hey everybody, welcome to this video. My name is Chris Harris, a certified financial planner, and today we're going to be talking about the basics of Roth versus pre-tax when it comes to your retirement plan. As a disclaimer, this video is for informational and educational purposes only and should not be considered investment, tax, or legal advice. Okay, so let's dive into this. So you've probably heard of, when you sign up for your 401k, should I do Roth, should I do pre-tax? Maybe you're unfamiliar with it. Maybe someone's told you about it, but it's kind of confusing. We're going to break it down in this video, hopefully make it simple so that you can make the best decision for your own retirement. So let's dive into really the first place that I wanted to start was with a really different types of retirement accounts. And the main ones we're going to focus on today are our 401k, okay, and we'll do it a little bit over here, IRAs, okay, individual retirement accounts and 401ks. So there are obviously a lot more. You can have 403bs, you can have, SEP IRAs, you can have solo 401ks, you can have 457 plan, and there's so many different types of retirement vehicles, but just for purposes of simplicity, we're going to just talk about these two main ones as the other ones have similar features as well. So we have our 401k. So what is a 401k? Well, this is something that is sponsored by a company. So a company sponsors this. You may have one at your work. You can contribute to a 401k plan. And so the company sponsors this one. You have higher contribution limits, higher contributions, which this is right now we have for 401k plans for 2026. We have it is $24,500, and then you can make a catch up of $8,000 if you are 50 years or older, or if you are in between 60 and 63, you can do what's called a super senior catch up, which is $11,250. Okay. So those are the limits for the 401k plan. You can sometimes you can take loans out of these. This just depends on the plan provisions. You're going to have a employer match, and not all the time, but sometimes you'll have an employer match. So that could be like a percentage of your salary or your contribution that they'll match. So they have different formulas for those, and that could have a vesting schedule, which is, you work there for so many years and then that gets vested to you so that you can keep those funds. If not, if you don't meet that vesting schedule, then you could get partial funds or no funds out of that match. Okay. So that's the 401k, just the basic form. And then we have an IRA. So these are going to have lower. This is an individual account. Now you can have, and we're not going to go over those, but you can have like simple IRAs and things that are associated with the company, but the IRA itself is an individual account, and you're going to have lower contributions. And for 2026, we are at $7,500 per year. And then if you're 50 or older, you can do another $1,100. Okay, so you can do an additional $1,100. You can't do loans, so there's no loans, and there's no match. Okay, you do get flexibility with your investments. Okay, so this does give you a little bit more flexibility. Most 401k plans, you're going to have a so many funds that you can choose from. With an IRA, you can choose the universe of funds if you want. So these are the two different kind of main ones that we're going to focus on. So now going back to the Roth versus pre-tax, I like to think of this as kind of buckets, right? So if you think the 401k, we have these two buckets. Okay, so this is our pre-tax, and this is our Roth. Okay, so with the pre-tax, we sometimes, so this is called traditional, like a traditional 401k or a Roth 401k. And so as you make your contribution into the plan, you pick one of these buckets. Okay, so a Roth would be after tax dollars. So we don't pay, so we pay all of our taxes, and then we make our contribution in. So we can fill up our Roth bucket, and then as we take this out in retirement, we're not going to pay any taxes on the growth or the distribution. So no tax, okay? Because we've already paid taxes before it goes in. On our paycheck, we pay our taxes, and then we make the contribution in, okay? So there's no tax, and then there's no what's called RMD. If you're not familiar with RMD, this is required minimum distribution. So with the required minimum distribution at age 73, and this change, it depends on how old you are, but if you are 73, then you are required to take distributions out of your pre-tax accounts, okay? So this is required if you're pre-taxed, okay? So like traditional IRAs, traditional 401ks, so you have to do the RMD. Roths, again, no tax, no RMD, and you just withdraw the money. You still have to wait until age 59 and a half in order to take the funds out, okay, without penalty. And there's some more nuances with Roths, and we'll talk about, we'll do that in a different video, but just some of the nuances of the Roth 5-year holding period and things like that. But with the pre-tax, so we have the 73, you have to take RMDs, same 59 and a half age for distribution, and it's going to be taxed as ordinary income. Okay, those RMDs, ordinary income, which can pose a problem, right? For IRMA surcharges. So we did another video on Medicare and, kind of the IRMA situation there, and how that can affect that and those surcharges. And so that income can also affect Social Security and things like that. So the income there is, and that's really where retirement planning has to be, done properly so that you can mitigate some of those taxes later on. But with the Roth, you don't have to deal with that. That's all income tax free to you, okay? Because you've already prepaid essentially you've paid your taxes throughout those contribution years, okay? So again, I like to think of this as buckets, right? So 401k, we have our pre-tax bucket and our Roth bucket. You can distribute your contributions and maybe split, 50% pre-tax, 50% Roth. So you can play with those. Generally speaking, you have to, look at the plan provisions, but you can split those. And then whatever the employer match, this generally will be pre-tax dollars. The company will get a deduction. However, with the new changes, they can also do Roth contributions as well. Okay. So let's kind of just change now our tune to the IRAs. So we have pre-tax or traditional. So same situation, traditional. This could be a traditional rollover IRA. And then we are going to have our Roth IRAs as well. So we're really just thinking these as different buckets within the vehicle, right? And just for tax purposes, how do we want to be taxed? And so with the traditional, same situation here. You have the 59 and a half before you can make withdrawals, and then you're also going to have to do your RMDs, okay? And it will be income to you. And then the same here on the Roth side, 59.5, no RMDs required. And then you're not going to pay no tax, no income tax to you, okay? Again, there's some nuances there in terms of if you do early or just principal value. But that's really, kind of the difference between the Roth, the pre-tax, how it's taxed, and how it can help you later on in retirement years, especially if you don't have to worry about RMDs and things like that. Okay, so basics are here. The last thing that I'll just touch on is that as you make the contributions into these traditional and the pre-tax accounts, these will be deductions. And I'm going to talk about that next slide. Deductions, there'll be tax deductions for you. And that's really where it's nice if you want to lower today's current tax liability, okay? However, just kind of more on the Roth piece and the traditional as well, there are income limits. So this is actually an important on the IRA. There are income limits. If you make over a certain amount, then you do not qualify for the Roth. And that become a little tricky. So we have to do what's called backdoor Roths. We're not going to get into that today, but and then there's also deduction limits for income as well. So if you have, already have a 401k, there are income limitations for deductions on your traditional as well. And so those are just some little nuances that you want to be aware of as you make contributions, okay? All right, so breaking it down just really, hopefully in a simple way from a number standpoint. So we talked about the Roth. So this is shielding from potential increase in tax rate at the time of retirement. We talked about that. The contributions will reduce your paycheck by more than pre-tax because it's made after taxes. So you're going to have less in your paycheck today as opposed to the pre-tax. And then you have to hold it for the 5-year period before it is considered qualified. So there is a holding. Once you open the account, you have to wait the 5-year period for it to be a qualified account. And there's some nuances in terms of what you can take out, principal amount and things like that without being penalized or taxed. So if we have the salary of $50,000, as an example, we have a $5,000 contribution. So really it's $45,000, but the whole amount, the $50,000 will be taxed, okay? Because it's after tax. So we're going to get taxed on the 50. We're making our contributions after tax. And then after age 59, after tax contributions plus the growth, we don't pay any taxes on it, okay? Which is really nice. If we go to the pre-tax as a summary, so contributions are made pre-tax, which is going to reduce the current adjusted gross income. And this is going to give you more income in your paycheck. Okay, so it's kind of a nice little kicker there. You're going to get the deduction. Distributions in retirement are taxed as ordinary income. Talked about that. So if we have a sample here, we have a salary of $50K. They make a $5,000 contribution. So $45,000 will be taxed and we'll get this $5,000 deduction. Okay. After age 59 and a half, pre-tax contributions plus the growth, we're going to be taxed on the distribution. Okay, so whatever we're distributing from the account, it will count as ordinary income, and whatever tax rate we're at in retirement, or when we pull those assets out, then that's what tax rate we will be paying. Okay, company match. So this is not always, but a lot of the time, most of the time, is going to be pre-tax. We do have the Roth component now that they can do Roth matches. They may have a vesting schedule. So we talked about that before. So again, it could be on a kind of a cliff. You work there for 3 years and then you're fully vested, or it could be kind of a graded vesting schedule. So each year you get a percentage of whatever they contribute to your plan as being vested. And then distributions in retirement are taxed as ordinary income as well, just like the pre-tax. The company gets the tax benefit and then you pay the taxes, but you also get the free money, so to speak. Okay. All right, so let's put this into kind of more of a planning technique here. So, and we've used Chris P. Bacon before. He's one of our sample clients. Um, and this is kind of to illustrate, the benefits of how, pre-tax versus Roth. And this is more of a simplistic view. What we did is we just changed from a traditional, 401k plan, and we just said instead of doing that, we're going to start with a Roth across the plan, with tax rates increasing at inflation. Okay, so that is going to really have an effect on the overall outcome because our tax rate is going to continue to climb. And so as we switch from the base plan was a traditional 401k plan, so pre-tax 401k plan. And now we did a scenario where if we switch that from a traditional, we wipe that clean and we added just a completely new, Roth 401k with the same provisions as the pre-tax 401k. We would come out with a value gain of $746,000. Okay, so you can see the green here would be the gain from our base case. Our base case is just what we initially model in, and then we show the difference here in this. The growth is the green, all the green. Okay, so ideally, the math on it should really be similar. Okay, so as we look at this, whether it's pre-tax or Roth, the math is supposed to work out similar, right? However, just to kind of explain that a little further, because we have the pre-tax is getting a deduction today, a tax deduction today, so you're saving on taxes today. And then the government says, well, we'll just take out at some future rate. So we're going to actually end up getting our taxes eventually, and then you're going to have to pay. So you're just deferring taxes. And then the Roth is saying, well, I'm going to pay today at today's rate, and then in the future, I'm not going to pay anything. Okay, so kind of flip them. And so again, mathematically, it's supposed to work out to be very similar. Now, this is really where it boils down to the kind of the strategy, how many traditional 401k or traditional accounts you have, or pre-tax accounts, whether that's 401ks, IRAs, and is that going to cause an issue in retirement? That's why we see Roth conversions being so popular. I think another way to kind of think about this is if you are on the younger spectrum, Roth, accounts can be enticing because you have all of those years for growth, and you're basically just saying, I'm going to pay all my taxes today, and continue through my working years so that I can, have all tax-free growth and distributions in retirement. So it's kind of a nice deal there. And then if you're, kind of maybe in the later stage and you have a lot of income and you feel like future years will be lower in income, so your tax rate will be lower, then maybe the kind of the pre-tax could be more beneficial for you to take the deduction right now while you're earning significantly more. So there's kind of just some ways to go about thinking about the pre-tax versus the Roth, and really, again, which one makes more sense for you. From an investment standpoint, there's also, some strategies you can use with Roth accounts, where it says, hey, we think this one's going to really go, and we want the growth to be tax-free in the future. So we're going to put maybe a higher growth investment, higher potential growth investment into the Roth as opposed to the pre-tax. So all of those things are really good to think about as it pertains to these retirement accounts and how to kind of navigate them. Because at the end of the day, when we do sign up for these 401k plans or decide to open an IRA versus a Roth, it is important to understand the tax, ramifications of either account, because it can affect you later on in retirement, whether that's, like I mentioned before, IRMA surcharges or Social Security, things like that, where it can really have an impact on retirement planning. Hopefully that made sense somewhat, and that you're able to take that information and use it for your benefit. We're going to dive into some other videos. We'll continue on and make it a little bit more, kind of more nitty gritty with some of these other things, but this just as a high level, this should give you a little bit more in terms of, shielding yourself against not knowing the Roth versus pre-tax. Okay. Thanks, guys. Appreciate it. And thanks for watching. We'll catch you on the next video.